Hello everyone, welcome to TaxExterminator.com, where we kill taxes dead. You're going to learn how to reduce your taxes legally beginning today. I'm your host, Brent Jordan, veteran tax attorney, former UCLA adjunct professor, and current district court trial judge. Today's webinar is entitled The 12 Biggest Tax Mistakes That Cost Business Owners Thousands of Dollars Each Year. The legal authority for this webinar is the IRS Tax Code, United States Treasury Regulations and Tax Court Rulings, the IRS Revenue Procedures, Private Letter Rulings, Publications, the Manual, and Tax Forms. Today's segment is entitled Missing Health Insurance Deductions. But before we begin, here's a woman watching television with her cat, and her cat suddenly flips out and screams at what the announcer is saying on the television, and the woman reassures the cat by saying, "He said flat tax, not cat tax." Today's webinar is going to focus upon 5 plans or accounts or arrangements. They're the Medical Expense Reimbursement Plan, otherwise known as MERP, the Health Savings Account, referred to as HSA, the Flexible Spending Arrangement, FSA, Medical Savings Account, also known as the Archer MSA, and finally, the Health Reimbursement Account, known as HRA. Today, less than 50% of small businesses offer employees health insurance, largely because of the cost. That's over 2.3 million small businesses that don't offer any health insurance. Under Obamacare, small businesses, that is, businesses with 50 or fewer employers, aren't required to offer health insurance, but most business owners want to. And there are new strategies of individual health insurance, such as the premium tax credits and guaranteed issued coverage. Now, when an employer does have a basic health insurance policies such as Blue Cross or Blue Shield, those policies have co-pays and co-insurance and deductibles. Sometimes they don't offer medical prescriptions, and most have no coverage for dental or vision. So these particular plans that you're seeing here today normally fill the gap. That is, when a traditional health insurance policy has a large deductible, for example, a $1,000 deductible, these plans that you see can pay for those deductibles. They can pay for co-pays. They can pay for co-insurance and medical prescriptions, and even dental and vision. Many of these policies, therefore, are supplements to traditional employer health insurance. But some of these plans are standalone plans. So let's look at them one at a time. First, the Medical Expense Reimbursement Plan. I like this comic. The doctor says to the patient, "I'm sorry, but stress caused by trying to figure out your health insurance is not covered by it." You're going to love the Medical Expense Reimbursement Plan. Basically, an employer establishes this plan under Section 105 as a reimbursement plan. The employer determines the amounts that are available for each employee for reimbursement during the period of coverage. Then the employer reimburses the employees for certain medical and other expenses under the plan. Any unused funds at the end of the year are typically carried over to the next year. What makes the MERP and all the plans popular is that the business owner obtains a deduction for the payment of medical expenses, and the employee does not have to claim any income for the receipt of money for his or her medical expenses. What makes the MERP very special, for example, is that the employer can set up a particular MERP. Let's say the employer has a child with braces. The employer can set up a MERP that says during the next 3 years, the plan will pay for all braces. Now, the employer has to pay for the braces of any employees that need them as well as a child, but you can imagine how creative an employer can be in this regard. Now remember, there's many requirements for these MERP plans that require a professional. But I just want to give you an idea of how this plan and the others work. Health Savings Account, otherwise known as an HSA. Now here's a nurse seeing a man, a new patient who comes in with an arrow sticking out his backside, and she says, "Let's see, accidents, alligators, apes, avalanches. Sorry, sir, there's nothing in your policy about arrows." An HSA plan is funded by the employer and or the employee. And like all the plans, the employer receives a tax deductions for contributions, and the distributions to the employees are tax-free if paid for qualified medical expenses. The HSA comes into existence in a very particular circumstance. That's when an employee has a high deductible health insurance plan, like a Blue Cross Blue Shield plan. For example, the employee has a plan with a $1,250 deductible. For a family, $2,500. So the HSA fills the gap. Payments are made for that deductible from zero up to the $1,250. That's how it works. And it pays for medical expenses. Next, let's turn to the flexible spending arrangement. What makes this particular account arrangement so inviting is, like the HSA account, it pays for medical expenses, and like the HSA account, it's funded by the employer and or the employee, and there's a tax deduction for contributions, and distributions are tax-free. But unlike the HSA, the FSA also allows payments for child dependent care services of the employee. That's worth repeating. The FSA will pick up for the employee's child's care services. Next, we turn to the medical savings account, otherwise known as the Archer MSA. One of my favorite comics, the psychiatrist is talking to the patient, and the psychiatrist says, "Of course you have a purpose in life. You pay taxes, don't you?" What makes the Archer MSA so special is that this particular account is created for self-employed individuals and employees of certain small employers. And the IRS defines a small employer as one who has 50 or less employees. And like the other accounts, it picks up the medical costs allows a deduction for the business owner, and distributions are tax-free. Finally, we come to the health reimbursement account. What makes this account special is that it's funded entirely by the employer. Check out this comic. In the maternity ward, the doctor delivers a child and he says to the couple, "Congratulations, it's a healthy tax deduction." As I said, what makes this account so particular is that it's funded solely by the employer. Everything else is pretty much the same as the other plans. There's a treasure chest of free money buried in your business. Claim it today. Well, that wraps up another segment of the 12 biggest tax mistakes that cost business owners thousands of dollars each year. This segment, number 8, missing health insurance deductions. I want to thank everyone on behalf of TaxExterminator.com, home of the proactive tax planning, for coming here today. And I look forward to seeing you at our next segment, number 9, missing investment deductions. For a limited time only, I'm giving away a free copy of my tax strategy book entitled 10 Powerful Tax Strategies That Pass IRS Scrutiny. I published the book with Amazon.com and Barnes & Noble, and you can obtain a free copy right now, today, at TaxExterminator.com.